weekend all. Ira Epstein of Linn Associates with your agriculture update with your weekend edition. And this is for Friday, the 8th of March, 2019. And we're just after now the 2:30 time frame. So I've got all the closes in that I want in the grains. And as you can see, we were down 6 3/4 in the bean. We got a penny pop, nothing there. And of course, in the corn market, down another penny. We had a cattle on feed report just come out as well. So when I come to that, market hasn't had a chance to react to it, but the cattle on feed came in at 100%. Estimate was 100%. Prior month was 102. So the amount of cattle out there right with the traded guessed. The marketings came in at 95%. Well, placements. That's the amount of cattle put into the feedlots. The estimate was 94. The prior month was 95. So we're still seeing a little less cattle. I don't know that you'd call that bearish at all. In the cattle marketings, we came in at 103% versus the estimate of 102 in the prior month, 99. So as fast as they're putting them in, they're moving them out. That's one of the ways to look at all this. Then when we look at the USDA grain reports, and I'm just going to look at the domestic, not the world supply-demand report. For the corn market, you can see you came in at 1.835 billion bushels, more than the trade was looking for at 1.736. In wheat, 1.055 billion versus 1.02 billion estimate, bearish again overall. 900 billion in the corn versus 902, and you saw the market was down 6 cents. And as you go down these other reports, you can see where they're at. Cotton pretty neutral. OJ market a little bit more orange juice than the market had thought as well. So you put it all together, and what you've got is a day that was interesting because the stock market had first plunged off of reports that we only added 20,000 jobs. But as the day is worn on, it's come back. Energies, which were down hard, are $1.70 off the low. Look at the crude, 80 cents off the low, 6 cents off the low in the rebob gasoline. So quite a difference. You had big breaks, and they've all responded back up. When we look at the monthly area chart of closes in beans, you still have not been able to get up on a monthly basis back up to the 18-month moving average of closes. When we take a look at weekly bar charts, and I'm going to stick with these Fibonacci numbers because they're pretty important, you'd gotten to 1071, and this was March of 2018. You broke down to last summer, 810.5. You've had a 38% retracement of that, and the market is still languishing basically at that zone and trying to break down again. In terms of the swing lines, which look at a previous week's high or low and draws the current week to it, and it uses rules that look at, are we having a higher week, a lower week in terms of higher highs, lower lows, where is the market on an inside week? You look at that. What about a down week, 2 in a row or so? The pattern has just come out to lower highs, lower lows. So the market with this break has re-entered a bearish pattern. To take that out, this pattern, you'd have to take out 921 on a weekly basis on the chart. Also, you've now closed under the 18-week average of closes. So you were unable to get to the 100-week average recently. The market has now gotten itself back under, for the first time in a while, the 18-week average of closes, putting into play the possibility that the lower Bollinger Band of 871.5 could be hit. Now, for those of you that are new to this, Bollinger Bands are an algorithm designed to keep the market trading within them 95% of the time. A way to look at them is resistance on the upside, support on the down, if you've got a market that's basically sideways. If you have a trending market, it's a little different. You can run the Bollinger Bands. Now, they get ahead of themselves when they start closing under it, and it's common to move then to the right-hand side of them. So you have to learn how to play with them. But because we're coming off of pretty much sideways action, my guess is 871.5 is the first support zone in the market, with resistance back up at $9.50, and momentum is pointing down. So we have the bias down because we're under the 18-week average. The longer-term trend is down. Support could be hit if the market continues breaking 871.5. When I come to the meal market, we're breaking out of a sideways action period. So on the weekly charts, I don't look at overbought, oversold on slow stochastics. I look at the way they're pointing. They're pointing down, that's bearish. The bias is down because the market is under the 18-week average, and we had an outside week. An outside week means you took out the previous week's high and low. Now, for me, the importance of that is two things. First off, if you take out the high of an outside week, it's often what I call an outside week down. It's a bear trap, often leading to challenge of the 18-week average. Because you're right there, it wouldn't matter. You'd be right back at that number before you knew what happened, because they're both basically today. This week's high of 308.60 is just slightly above the 308.40 18-week average. More important to me, at least, is sideways action is how trends develop. If this market decides to break down, then the power of the sideways action pushes prices even further lower, because this group wins and those that are long in there start bailing out at a minimum. That's not to say you won't get new selling in the market. In the soybean oil, this market had more value than the meal market. Now, I can come back here. You can see how meal didn't do anything, and yet the oil was in a rally zone for that. Now that rally has seemed to end. You've got the pattern of lower highs, lower lows. You're not in a downtrend because prices are still over the 18-week average, so I say the two nullify each other. Momentum pointing down. If the beans and the meal were to break down, I would assume that the soybean oil probably gets dragged towards that 18-week average of closes. In the corn market, you have lower highs, lower lows. You're now a bit excessive on the downside. You're under the the lower Bollinger Band. Now let's take a look at that. You weren't last week, you are this week. 95% of the time, the market will stay within the Bollinger Bands. But when you get prices that were sideways, and if you study right here to here, you had a brief sideways period. When I say brief, remember, these are weekly charts, so that's about a month and a half of sideways action. It's trying to push the market to the downside. Let's assume you get a spin back out of the oversold area. Well, the first thing would be to get over the Bollinger Band. Right now, the lower band is at 357.5. Next resistance point, 365, and another one at the 18-week average, 372 3/4. In plain English, this market's loaded with what? Resistance above it, and momentum still pointing this market down. In the wheat market, it's been pretty much a free fall. You can see how poorly the market did this week. And you've got 1 week under there, 2 weeks under, 3 weeks under. You weren't under the Bollinger Band there. So I give the market, I count each successive week as one of the percentage points of the 5% of the time the market's out of the Bollinger Bands. That gives me a 2% chance that next week the market will do that. That does not mean you're a buyer there looking for the market to come up. First off, in these videos, I don't say buy here or sell there. I do that in my morning subscriber video. What I do here is I show you the momentum ideas. Would you disagree that we had sideways action here? If you break out of this and you can push on it, the 100-week average could become the first support. You went through that, and this is what you've been doing. And this came about, in my opinion, at least as a chartist, because of that sideways action. When it stops dropping, when the market finds it gets bids in it because U.S. wheat starts becoming a leader for export. When you're in the cocoa market, you've just come out of this sideways action. So keep your eye on this market. It is not looking good. The market finished off today at 21.99. 22.39 is right here. Your 100-week average is here. So what the market did is this week you came down, probed through the bottom, and came roaring back up, rejecting the idea that you're staying under that lower Bollinger Band. While that happened, momentum didn't move at all. It just stayed steady. So as I look at this chart, on the weekly basis, it's neutral. You have a higher high, a lower low. You had a failed attempt to break out to the downside, and you're back into a resistance area with momentum flat. In the sugar market, we had an attempt at a rally. You can see how that carried with the momentum right through here. The objective might have been the upper Bollinger Band. It failed. It went to the 100-week average, came back looking for support at the 18-week, and now it's bursting through that. So what we have is not sideways action. That's the first thing. You can see how the bands are not going quite sideways the way we have in other markets. We're also not trending. You have a higher high, lower low on the chart. Momentum is mentioned by the slow stochastic is down and bias is down. Support, the 11.99 area. In the coffee market, this is still very much in the bear camp. You have the lower highs, the lower lows. Momentum is down. If the market breaks down again, I would be looking for the lower Bollinger Band as a possible support zone. And I think you'd have eager sellers if the market rallied back up towards that 18-week average because trend and bias are down. In the cotton market, while this market has had an attempt at a rally and for the week was up 76 points, you've had this for a bit. The market tried to get through the lower Bollinger Band, didn't. It tried it here too, and it succeeded in 1 or 2 times. Then it bounced away, came down to challenge it, got another bounce in the market, and then it started working itself with higher lows, higher highs. So while the trend is measured by the swing lines up, it's countered. And it's countered because you still haven't closed over the 18-week average, so the bias stays down. Bias down, trend up, we call it a wash. As for the momentum, it's trying to pick up, but not very strong. So the 18-week average looks like a resistance point. In the cattle market, the momentum has stayed bullish. It's just going sideways over 80. I call that bullish. The market has a pattern of higher lows, higher highs, very much in the bull camp, and I didn't see anything in this cattle on feed report that should be a surprise to the market. When I look at the hog market, you've had a pattern of lower highs, lower lows. You went down to one of the objectives, the lower Bollinger Band. Momentum started to flatten out on you there, and now momentum is pointed up. The market's closed back over the 18-week average. It's very much in a sideways trade pattern now, and it's got divergence. You've got the swing line down, but the bias up. I call the two washing out each other. You know, one of the things that I love to do here is teach. And let me see if I can get this back for you here. I don't know if I can. There we go. One of the things I said I love to do is teach. And in the morning, what I do is I put out a subscriber video, and I've done this for a number of years, a lot of years. And in that subscriber video, unlike these, what we're able to do, because it has to have a user ID and password, is I can say, buy here, sell there. I don't have to talk the generic way that I'm doing right now. It's a lot more fun for me, and it's probably a lot more fun for you, because my thought process is this. If you're like me, you want to put on a trade, you think you don't question yourself? I question myself when I'm telling my clients what to do. You can count on it. So I cover all these different markets, and what I'm able to do in each one is tell the traders, what do I see in the chart action, the active, the technical and fundamental. So I'm telling you what I think the pros are doing, and I throw out the ideas. As you're throwing things at me, like I've added QQQ, now I'm adding the energy spider ETF, I throw in these things now. So I'm expanding the service a little more for those of you that are trading these ETFs to start covering those in more and more detail every morning. I do the recording at 8:30 a.m. Central Standard Time, and the reason is because that's when the stock market opens. That is when they reopen the grain markets. That is when the meat markets open up and a lot of the option pits reopen. Yeah, you have some trading before them, but they close for the morning session, then they reopen them. So once you get used to that, you understand by the time I'm recording, I'm within 2 minutes of the opening. I finished my recording. It's about 15 minutes. Render it. It goes very quickly. And it's posted typically before 9 o'clock. The idea there is to throw out ideas at you. You might be sitting on the fence post saying, gee, I'd love to do that. What if I say, that's the same trade I see? What if I say, no, I don't like this trade. I don't see a trend in there. Maybe that's the other push you need. The idea is, instead of you talking to a broker who's trying to talk you into a trade maybe, I'm there, I'm not talking to you, I'm telling you what I'm seeing. It's not very expensive. 26 cents a day to see basically if you like the service. After that, you can buy a year subscription, $156, pay it up front, or go $15 a month. But why not give it a try? Keeps us going here, keeps something for you. You can call us. You can go to our website. On the website, you'll also see you can go under Research or Education, Morning Subscriber Video. Take it from there. I'm Ira Epstein. Have a great weekend.